Investing in the stock market is one of the most effective ways to build wealth over time. However, you need to engage in portfolio management to do so successfully. Creating the right stock profile is critical because it can significantly reduce overall investment risk. If you're wondering how to build a stock portfolio, this video is for you. Let's look at some of the most important factors to consider. Watch the video till the end, and don't forget to subscribe to Shareholder for more uploads like this. Here we begin. Number 15. Value investing. Value investing, like growth investing, is recommended for long-term investors. In this strategy, you seek out the least popular stocks with the lowest prices. In addition, value investing stocks typically have high cash flow, dividends, earnings yields, and high sales and book value to share price ratios. Number 14. Keep risk appetite in mind. Choose a mix of aggressive and defensive stocks from various sectors based on their fundamentals, such as management pedigree and business scalability. While high beta and cyclical stocks typically lead a market's bull phase run, including defensive bets in your portfolio can help you build wealth over time at a lower risk. Number 13. Growth investing. The strategy is recommended as long-term investors who are willing to take on the risk. The method of investing entails identifying stocks that outperform others in terms of growth. While you invest in a company with high growth potential, you can profit from the company's profits. When a company makes money, its stock price rises. However, such stocks do not pay dividends because their funds are used to expand the business. Number 12. Income investing. This strategy is recommended for long-term investors who are willing to take on risk. You can use this income investing strategy if you have a low risk tolerance. The goal is to increase income by investing in high-yielding stocks that pay a high dividend. The price of this stock is mostly the same. You can generate consistent income by diversifying your equity portfolio and including dividend stocks. Dividends are typically paid once every 6 months. Number 11. Focus on equity. Investing is also about making more than just having a well-protected and best-performing equity portfolio. It's also about making money from your investments. When it comes to equity investments, you should aim to accumulate wealth. To accomplish this, you must concentrate on the equity portion of your portfolio. Even though equity investments are risky, there is always a better way to mitigate these risks. There are several approaches to this, including income investing, growth investing, and value investing, among others. Number 10. CAN-SLIM approach. William O'Neill, the founder of Investors Business Daily, developed this stock selection method. His approach is encapsulated in the acronym CAN-SLIM, which stands for, a company's current quarterly earnings per share must be 18 to 20% higher than a year ago. The annual earnings per share must have increased significantly over the past 5 years. The company requires something new, such as a new product or a change in management. The company should try to repurchase its own outstanding shares, which is common when companies expect high future profits. Instead of lagging, the company should be a leader in its category. The company should have the same institutional sponsors, but only a few. The investor should understand how the overall market affects the company's stocks and when to buy and sell it. Number 9. Dollar cost averaging. DCA is a common investment strategy used most commonly with mutual funds. An investor will set aside a set amount of money to be used to purchase shares of one or more mutual funds regularly. Because of the price of the funds varies from one purchase period to the next, the investor can lower the overall cost basis of the shares by purchasing fewer shares when the fund price is higher and more shares when the price is lower. Dollar cost averaging allows the investor to profit more from the fund over time. The true value of DCA is that investors no longer have to worry about buying at the top of the market or carefully timing their transactions. Number 8. Dogs of the Dough. In his book Beating the Dough, Michael O'Higgins simply outlines this strategy. The Dough, dogs, are a stockpiling strategy that involves selecting Dow stocks with the highest dividend yields. Those who buy these stocks at the start of the year and then adjust their portfolios annually have typically outperformed the index over time, although not every year. This strategy is followed by several unit investment trusts, UITs, and exchange-traded funds, EFTs. So investors who like the idea but don't want to do their own research can buy these stocks quickly and easily. Number 7. Market timing. Those who follow closely the markets or specific investments can outperform the buy and hold strategy if they can correctly time the markets and consistently buy when prices are low and sell when prices are high. The strategy will obviously produce much higher results than simply holding an investment over time, but it also necessitates the ability to predict market movements correctly. For the average investor who needs more time to monitor the market on a daily basis, it may be better to avoid market timing and instead focus on other long-term investing strategies. Number 6. Diversification. If a portfolio is not diverse, it is not a good investment portfolio. You can spread your investment risk across multiple asset classes or subclasses with a diversified portfolio. By doing so, you significantly reduce the risk. In the previous example, you made an asset allocation of 80-20 in favor of dividend stocks and growth stocks. You can further diversify it. You may wonder how. Dividend and growth stocks should be split 80-20 across multiple sectors and market capitalizations. Number 5. Invest in growth sectors. Investors seeking aggressive growth should consider sectors of the economy such as technology, healthcare, construction, and small-cap stocks, which offer higher returns in exchange for higher risk and volatility. Longer holding periods and careful investment selection can mitigate some of this risk. Number 4. Asset allocation. Once you've determined your objectives, the next step is to allocate resources accordingly. You will need to assess your risk profile and tolerance for this step. This will allow you to make better decisions. For example, assume you're thinking about retirement 20 years from now. You're also a moderate investor with a moderate risk tolerance. In this case, an asset allocation of an 80-20 split between dividend stocks and growth stocks would be preferable. Number 3. Buy and hold. Buying and holding investments is the most basic strategy for achieving growth, and it can also be one of the most effective over time. Those who buy stocks or other growth investments and keep them in their portfolios with minimal monitoring are frequently pleasantly surprised with the results. A buy and hold investor is typically unconcerned with short-term price movements or technical indicators. Number 2. Your goals. The first step in developing a stock portfolio is determining your objectives. Before attempting to compile a portfolio, it is critical first to determine your end goal. This way, you can ensure that your investments are bringing you closer to your objectives. For example, if you're 25 years old and want to buy a house in the next 10 years, building a portfolio of growth stocks may be the way to go. Number 1. Rebalance your portfolio when necessary. Investing and forgetting do not work in today's world of ever-changing dynamics. Certain stocks in your portfolio. Because of these conditions, it is critical to rebalance your portfolio by exiting such companies and investing in better opportunities for the future. So what do you think about these stock tips? Let us know in the comments section down below. Make sure to subscribe and hit that bell notification icon so you never miss an upload from our channel. Thanks for watching. Take care.